Indian financial markets are structured into four parts. One is the money markets and another is the securities market. Securities market are basically has two components: initial public offer, that is the primary market, and secondary market. Primary market basically consists of your initial public offer given by the companies, and secondary market is nothing but buying and selling of share. Money market again has three components. One is the organized money market. Organized money market happens between the Reserve Bank of India and bank and between banks. The interest rates are generally agreed between the banks, but as far as the Reserve Bank of India is concerned, it is the rate of interest for borrowing by the RBI is reverse repo rate, and for selling is by the repo rate. Next is the unorganized money market, which is usually consists of unorganized lenders and borrowers. And finally, you have something called as the submarket. Submarket has got 4 5 components. The first component is the call money. Call money is nothing but buying and lending happening for a very short period of 14 to 90 days between banks, between financial institutions, and between the Reserve Bank of India and the financial institutions. The next is the term money market. Term money market has a tenure of about 3 to 6 months. Term money market happens again between banks and the financial institution, and it can happen between the Reserve Bank of India and the banks. The next is commercial papers issued by the reputed companies. Commercial paper are not secured bonds, so one has to be careful with that. It is like any other bond issued by a government agency. The next component is the commercial certificate of deposit. See, certificate of deposits are generally issued by the banks. Here, if the retail person or any person deposits some amount with the bank for a period of 3 to 6 months as specified by the bank, then the interest rate which the bank is going to give will be higher, very high compared to the savings bank interest rate. So this is known as certificate of deposit. It is a very safe investment option. See, commercial bills is a slightly complex. Here, suppose a company has sold some certain amount of goods worth 100 crores, which is on a bill. The bill which is made is for 100 crores, including profit. Now the company, but the borrower, the person who has purchased, he say he will make the payment only after 2 to 3 months. Now the company wants immediate for daily working capital requirements. So what does the company do? The company will sell that bill to a bank at a discount. Suppose if the bill is made for 100 crores, the company will say that I will be happy with 90 crores, and the bank will give immediate 90 crores to the company. So this is known as commercial bills. And finally, the treasury bills issued by the government of India.